S&P 500 closing at a record high for the second straight session following the release of the Fed minutes from the January meeting. Let's bring in Charles Schwab, Chief Investment Strategist, Liz Ann Sonders. Liz Ann, it's great to have you back on the show. Welcome.
Thank you.
That's exactly where I want to start. The fact that stocks continue to churn to these record levels despite what I would call a wall of worry for investors.
Well, that might be part of it, but I think that because there is yet to be any true meat on the bones in terms of policies, the uncertainty right now, but what it will actually mean to things like corporate earnings. We know that tariffs were mentioned on earnings conference calls to a much greater degree than even what we saw at the peak in the 2018 trade war. So there is that uncertainty. But given that we're still now at the tail end of earnings season, it was a stronger earnings season. I think that's been supportive of the market. But there is a heck of a lot of churn going on underneath the surface. I mean, today is a perfect example of that. Materials and financials are leading year to date, at least for yesterday's close. They're the only two sectors in negative territory today. So it is a tricky environment to navigate at the sector level.
The fact that we have seen this broadening out in the market and the fact that you have seen some of these more cyclical sectors being the leaders, at least up until today, what does that signal about the health of stocks?
Well, some of it, I think, is just a move to areas that have not been leadership areas, financials being among them. Materials, I think, is a function of the strength in commodity prices. So I think that there are sort of individual stories behind what's working. In fact, what's interesting is that studies have been done recently showing that macro is becoming less of a driver of the market broadly, even groups of stocks, and it's individual company fundamentals that are driving individual stock performance, be it earnings or whether you're domestic or international, what industries you're in. And I think that's arguably a good backdrop for active managers, not over passive, but it levels the playing field a little bit when you have that price discovery and you have that reconnection of fundamentals to stock prices.
Liz Ann, U.S. markets have been doing so much better than a lot of international markets over the past few years. But this year, there's been a little different action. So how should investors who are maybe outside of the traditional portfolio balance toward international stocks and markets think about that?
Well, we typically espouse having international diversification. That's part of the across asset classes and within asset classes. It's been a harder sell when you have the concentration in performance, not just in the U.S., but within the U.S. market until recently, the concentration in areas like the Magnificent Seven. And I think a year like this is a healthy reminder of the risk associated with that concentration, the risk associated with not rebalancing, whether it's from the strength in the U.S. to overseas or some rebalancing within the equity market, not allowing that concentration risk to exist in your portfolio via the absence of rebalancing. So I think action like we're seeing this year with international outperformance over U.S., with the Magnificent Seven showing a lot of dispersion and general weakness relative to the overall market, I think it is a somewhat healthy reminder to investors about that concentration risk.
So how do you and folks at Schwab talk to investors about the process of doing that kind of rebalancing? It's not always, I guess, as simple as just going into an international fund that's spread, across everything. Should investors think about particular themes, whether it's demographics or whatever it is that they believe in, and decide how to apportion things?
Well, it depends on who the investor is. We have a wide array of what we call strategic asset allocation models that run from very conservative up to very aggressive. And that is dependent on the individual investor, where they sit on the risk spectrum, what their time horizon is, what their income needs. I mean, the list goes on, et cetera, et cetera. The more risky end of the spectrum, that's where you're going to maybe have a little bit more exposure to emerging markets, maybe even frontier markets versus developed markets that may be more appropriate for a slightly more conservative portfolio. But to the first part of the question with regard to rebalancing, one of the opportunities that comes when you have a lot of churn inside the market is it gives you the opportunity to do portfolio or volatility-based rebalancing. A lot of investors will do calendar-based rebalancing. They might do it quarterly or they might do it annually. When you get some of this churn, it gives you an opportunity to do what rebalancing affords you the ability to do, which is not so much buy low, sell high, but add low, trim high. So using it having that rebalancing be driven by and a guide from your portfolio is one unique way to think about rebalancing versus just doing it based on the calendar.